Hello and welcome to Nicsa Talk, the podcast for connecting and supporting the people of the asset management industry. I'm Nicsa's Jeff Lamoureux, and today's episode is Sales and Asset Forecasting, Modeling in an Evolving Global Economy. It's a recording of a recent Nicsa webinar sponsored by Delta Data, in which 3 experts take a deep dive into the challenges and opportunities related to market modeling programs. Now here's the panel's moderator, Delta Data's Jason Davenport.
I'm VP of Sales here at Delta Data and have been working in the financial technology space for about 20 years. During the majority of that time, I have worked in product strategy and client services, helping firms in their data initiatives. Recently, I've moved over into our sales organization where I work with asset management firms to show them how our software at Delta Data can help them become more efficient in their oversight activities. I'm also going to now turn it over to Tyler and Whitfield, our other panelists, for some quick introductions on their end. Tyler?
Hi, I'm Tyler Clardy. I'm a senior manager with Casey Quirk by Deloitte. So we do strategy consulting within the investment management space. I also run our knowledge center, which does a lot of our primary research activities, talking to asset managers across the landscape, as well as intermediaries and key buyers.
Great, thanks, Tyler. Whitfield?
I'm Whitfield Ap. I'm CEO of Delta Data. I've been in this industry about 25 years. I've spent time at both large broker-dealers and time at asset managers. Very excited today to talk about forecasting, which is, from a technology standpoint, a nascent capability in the industry, but it's been around forever. All of us try and forecast the future based on assumptions about our business, whether you're running a technology company or an asset management business. So really interested today to hear Tyler's insights and to have a good discussion on this topic.
Great, thanks, Whitfield. Just to lay some of the groundwork, really, for the next hour or so, we're going to give a brief overview of the current state of our asset management industry. And from there, we'll take a look at the evolution of economic modeling and the challenges that are presented during periods of global unrest. We'll then move on to some of the ways to overcome these challenges, talking through some of the best practices that we've heard from our asset management clients here at Delta Data. So with that, I'll turn it over to Tyler, and he can kick us off with really talking through the industry today in regards to the market environment and where we are.
Thanks. Yeah, happy to jump in. So as everyone is intimately aware, right, this has been a pretty unique year for the industry. And I think it's created a lot of volatility in both the kind of market levels, the underlying financials of asset management firms, as well as the way that investors are reacting. So I think that kind of ties in pretty tightly with, how do you think about forecasting in this environment becomes pretty challenging. Just to give a pulse of where we are, right? As the year ended in 2019, the industry is at a pretty great all-time high, right? If you're thinking about, margins have been pressured by, fee compression overall and some move towards passive, but overall still really robustly profitable organizations. AUM has been riding high in terms of just continued capital market appreciation. Revenues were up, and although managers' cost structures had been increasing, a lot of that was kind of due to increased investments in technology and often risk and compliance as well. So overall, coming into the year, I think firms were feeling pretty strong and stable about their overall financial footprint. Fast forward to March, you had a pretty drastic drawdown in the levels of the market, which pulled down AUM and associated revenues pretty starkly, right? So you saw a 12% drop just in Q1. And this hit margins really aggressively. And firms tried to react really quickly with the information that they had to be able to make moves to control the bottom line. So focusing on costs, right? So reducing T&E expenses, reducing market data expenses, reducing things that ideally didn't require cutting headcount, as most firms were trying to avoid that during the pandemic period. through Q2, Q3, right, I think we've seen a pretty amazing V-shaped bounce back, which I don't think anyone was really anticipating. So the speed of the recovery of at least the levels of the capital markets have been surprising and started to buoy some of the financials of asset management firms. But I think there still is the view from the C-suite that, there is tremendous potential for volatility in this market, both on the upside and the downside. So trying to project, what kind of capital expenditures do you want to make? What type of investments are you going to make to reposition the firm? It's a difficult time to make some of these big decisions, and at the same time, there's a lot of kind of really substantive choices that these executives need to make. And we'll talk about that a little bit more in the second page. On the investor side, right, there's been a couple interesting factors, right? So if you talk to many chief investment officers coming in previous to the market crisis, I think there was, some sentiment that, in the next market crisis, active management will be validated and that investors would kind of return to actively managed products. And what you saw, at least through Q1 and Q2, is structurally things really did not change. So investors flew to safety and pulled a lot of money into money markets in Q1. But largely the dispersion as they returned into the market between active and passive was kind of the same as it was before. In active equity, it was largely on the passives, or on equity, it was largely passive exposure. In fixed income, it's still a little bit of a split with active pushing ahead. On the kind of channelization side, it was somewhat interesting because if you looked at previous financial crises like 2008, you saw retail investors get out of the market and stay out of the market. And in this particular crisis, you saw them kind of move quickly to the sidelines, but come back in quite aggressively early. So particularly as firms think about their channel mix, their product mix, thinking about how to project what that forward future is going to look like in terms of asset mix shift, overall fee yields across their product set. Obviously, that has kind of wide-ranging waterfall implications for their overall financial health as well. Whitfield, not sure if you'd add anything in terms of the overall flow and financials picture.
Well, I think that these are incredibly insightful observations. I think it was really interesting while we were prepping for this call to look at the numbers. I think we all kind of had a feeling on these macro numbers, but directional. It's great to see these things in black and white because you realize the stark reality of getting to plus 7% in a matter of months. It's a bit of a whiplash more than a V. The question is, I would pose for those on the call who are, and this is a call about forecasting, pretty much every shop that we have talked to, and we have about 25-ish asset managers as clients, everybody does the job of forecasting. I think an interesting question, which we can't do live polls, is how many of them reforecasted in early April and then reforecasted again in July, because as you pointed out, I don't think anybody was really expecting this roller coaster ride. I think we all knew when the Swan event happened, it was heading down, but what the recovery could or even would look like, I think in March there was a question of would. I was intrigued by how would forecasting fit into this? How would we use it? And, to your point, there are waterfall effects off of these large movements. If this happens, then that happens. If that happens, then, so on and so on. And when I try to get my arms around it, I think if you simplify what the asset management, the powers that be that are trying to run an asset management institution are trying to do here is say, how do we make informed decisions proactively and then wait for the market to determine which decisions we make? And I'll unpack that just a bit. You're right. Everybody was able to avoid layoffs, but I'm guessing more than 90% of them had some floor trigger that said, if the market got here or stayed at this level for X number of months, we're going to make this move. And then if it further does not recover, then we're going to do another move. Those types of predicated decisions are in today's modern company are almost always predetermined. So the forecasting is important to allow the executives to say, hey, here's the possible paths we take. And if the market does have a V-shaped return, which I think people would have thought was improbable in the first week of April, you can plan for it. And if it has a 9-month flat line at 35% down on assets, you know what the impact to your company is, and you understand what is the magnitude of hardline cost cuts you need to make. So yeah, I was really appreciative that you brought these numbers to the table, because it helps us move beyond a theoretical discussion and into a numbers-based, quantifiable discussion. And then this whole conversation that the three of us are having today is around, okay, if you have the numbers, what does your forecasting program look like to allow the key decision makers to map out the potential outcomes and plug in the effective changes they need to make to their business, and then let the numbers do the decision making from that point on, rather than being on their heels, reactive, and kind of living in the moment, which I personally don't think the best decision making comes from.
Yeah, I'd agree. I think one of the other elements that has compounded these trends that you see, especially when you start to compare it against previous market crises, is that I think the common playbook by many firms was, hey, there's a pretty huge buffer in our business because we've got a lot of variable compensation, and we can take that up and we can take that down during periods of market volatility. I think what we've seen over time as well is the cost mix of asset management firms has shifted. So the big investments that firms are making into data, into technology, into fixed cost elements are starting to reduce the size of that buffer, in which firms could kind of manage through some of these elements by just ratcheting up incentive compensation up and down. So I think that is another kind of compounding effect that we see that firms are facing now that they might not have faced in the past.
Yes, Tyler, I think you're really getting into the details around what a forecasting program is trying to suss out. So in our understanding of this industry, the number one cost is people. And to your point you just made, you have a fixed cost of people, and then you have a variable performance-based and either role performance-based or firm performance-based component that creates a variable number on top of your fixed personnel cost. The second biggest expense is your distribution expense. The distribution expense is largely AUM-based, but we see many instances of fixed costs, but not to the extent of if you looked at like personnel costs, where the fixed cost is a much bigger chunk of the overall expense. And then, another interesting thing that's been impacted over the last 6 months is real estate. Real estate comes in at the third highest expense in our understanding. And there's, I'll be honest, 3, 4, and 5 real estate infrastructure, that sort of stuff, software expenses, they're all a distant third, fourth, and fifth to the big ones, which are FTEs and distribution expense. But to your point, a good forecasting program is able to rapidly take input and define what's fixed and what's variable, and based on those inputs, tell you what the magnitude of the variable is, so that you know how big that buffer is in any business scenario going forward. And that business scenario, that buffer is the thing that's hard to kind of calculate in your mind. I think most of the folks who are making decisions in asset management complexes can do the back of the cocktail napkin and say, about 30% of our comp's variable. So if the industry is really just terrible, we're going to drop from, I'm just throwing a number out there, from 100 million to 70 million in comp this year. But they couldn't tell you, is it 26 million or is it 38 million? And if the market comes back by 3%, then what? That's where it starts to get a little gray, and a good forecasting program can not only project out scenarios, but it can answer those questions. What if we see a 3-month bounce back to near pre-COVID levels? Well, a good forecasting program should turn that around, not in those 3 months, but in a matter of, minutes, if not days at the worst, to say this is what the variable buffer looks like if that happens. Because then they can look at how much cash they're sitting on and say, all right, can we absorb that or not?
Yeah, absolutely.
Hey, Whitfield, it's a good point. And, as we've heard from some of our clients, can you talk through why they're now pushing, or what kind of the evolution of forecasting engines and what they're doing today, or, how things have worked and the reason they can't turn those around in a couple of minutes, and kind of where we're seeing them go and what they're asking for as far as software? Whitfield, are you there? Sorry.
Yeah. So Tyler, I do want to include you in this question. Tyler, Casey works in a lot of shops out there. Where did the forecasting function originate? Can you talk through where this started and what its use was? And then I'll talk a bit about how our shops that are using our tools are evolving it into the latest use cases.
Yeah, so I would say predominantly the forecasting function originated within the CFO and finance vertical, right? So it's trying to provide management guidance upward on kind of various scenarios. I'd say over time we've seen it start to balkanize to some extent, right? Where certain functional units are trying to create better insights on their spending, on potential revenue and inflows, such as kind of more analytics within the distribution function, kind of greater details up as you look at kind of various regional geographies and if they own separate P&Ls as well. So I'd say it's moved kind of throughout the firm as there's been more onus on kind of investment and more views as to how are you driving ROI. And what are kind of the more granular focus on the costs that we're spending across these various functions. And a lot of that has been solved by adding bodies, right? By throwing people at the problem. I think there's been the view of trying to add kind of data and systems. What we've seen, at least from our perspective, is that firms bump into a couple problems. One just being siloed data, lack of kind of data quality. And then, just the ability to put kind of the right analytical tools around them to be able to speed the analysis and have all the inputs that they need in order to create the type of kind of just-in-time or as close to real-time analysis as possible. But we'd be interested to see if that's kind of relatively consistent with what you're seeing out there, and if firms are making kind of moves to leapfrog the competition there.
Yeah, so that was our understanding of the history that had our clients who have signed on to this have kind of walked us through. They took similar journeys to this point. And to answer directly the question from Jason, most of the asset management shops that we get a look at their process, there is a core set of spreadsheets that have from some fairly significant data gathering activities that go into the preparation of the spreadsheet. And then there are a series of interactions with key groups to program the spreadsheets with information that would influence a single one model. And that model is usually coming from the economist or chief economist, or it's a average of 2 or 3 of their economic expectations. This whole structure is supported by the finance group, the structure, the business process of collecting the data, talking to the different influential groups like sales, and then working with the ops team that does fees to help understand the distribution expenses. And then lastly, a lot of custom macros in the spreadsheet spit out a fairly detailed flow forecast going forward. And interestingly, in the two that I've spent personal time with, there's quantitative individuals who have quant in their business title at the shop doing the work. I literally couldn't describe a more difficult thing to execute in today's environment with any higher value people than high-end finance, quant people, and working with your sales team one-off in spreadsheets. It's a recipe for expense, for sure. It appears that all the shops we're working with, they are able to do it and are able to do it very accurately. But what we do see is that if we ask why aren't there 3 models, they usually just say, well, we haven't been asked. So if you were asked, would you be able to produce it? And the answer is likely not. There's just too much time required, and without a structured workflow to gather the input and then apply those inputs to multiple models, there's just, at every point, there's more complexity. So as we looked at what is the 24-month roadmap that we want to evolve into as a partner with our asset managers, regardless of the software, you want to take that business process and be able to execute it on a moment's notice with different variables and have a firm conviction that the output is going to be consistent, because if it's not consistent, you can't make decisions off of it. So where we are working today, and really it's not, yes, software comes into play. It's like any other business process that we've tried to scale and get better at with our clients, and that is make it streamlined and repeatable to where you have confidence in the output. And if you streamline it and automate it enough, you can run it whenever you want with little additional cost. So whereby today, I don't think the business, knowing what goes into the process, would ask on April 7th, could you model out these 2 other scenarios? We're trying to get our clients to a point whereby the answer is not, hey, can you? They're sending to them updated scenarios because the cost of running the next scenario is quite low. I mean, if you think about when we make investment decisions inside of a portfolio, a modern portfolio management program, you're literally running Monte Carlo analysis on hundreds of scenarios, trying to figure out what's the most likely outcome for a set of investments. So why we don't apply that same logic to what's the likely outcome to the overall projected forecast, which so many decisions are being made on, I think it is a bit of an operational and technical limitation that needs to be removed, and then let the business determine, the decision makers determine how many models do they want to look at, and what inferences does the technology provide for them. It's the same set of decisions at the end of the day, and it's definitely not a crystal ball. But you would think that we would be supplying the business decision makers with a wealth of information that is reforecasted at any given moment for pretty much any given reason. But I think today the cost, the personnel cost, the time to take and get it right, it takes a while to get it right. Is just too high a bar to be doing this on a daily or weekly basis. The backside question of that is, why in the world would you do it daily or weekly? Well, I think we just lived through the why. The market moved literally, minus 35 plus 5. It's a 40-point swing in the NASDAQ. That's just crazy. And I mean, that's crazy. And I worked at Lehman Brothers. I've seen crazy. That's even crazy. I personally think that the volatility we're seeing today is not going away, and that volatility, as it persists in the environment that we have to make decisions in, forecasting becomes more important. That the forecast you're operating off of is the very latest forecast based on the very latest information that they have.
Yeah. And Whitfield, the slide that is showing right now also kind of hammers home that point, right? You mentioned the volatility in financials. So I think there's how do how do we keep a consistent cash flow margin and making sure we're, managing through this volatility. But I think, when we've gone out and had a lot of conversations with CEOs and other executives, right, there's some pretty substantive investments firms need to make in order to retool their businesses to be successful over the next 5 to 10 years. And thinking about how are these going to be funded? When is the right time to invest in them? And how big of a bet can you make is going to be obviously dependent on a lot of those factors that Whitfield mentioned. I think there's some big questions around, right, if this is the kind of working operating model, what additional technology, what real estate can I get rid of? How do I kind of reinvent my talent model? There's a lot around just kind of creating a more seamless operating model. There's investments that need to be made as you think about, right, how do you sell to new clients in this very digital only environment? What does the new client experience look like? So substantive investments there. The active management engine, right? We talked about continued deterioration towards passive and, big investments like, private markets, ESG and using quantamental capabilities, right? These are all chunky decisions. Some firms are even thinking about, do I want to reevaluate my global or my view towards globalization? So a lot of firms, aspire to be global managers, but, other geographies have not proved to be as profitable or as large of a source of growth as their home markets. So there's questions as to, do I want to double down and really grow globally, or do I want to retrench towards my a smaller set of markets where I feel like I can turn the needle? And clearly we're seeing M&A, right, with the recent transaction between Eaton Vance and Morgan Stanley, right? M&A is clearly back on the table, and making those kind of really large transformational decisions for firms. Clearly you need to rely on having good data at the right time quickly, to be able to kind of chart the future of where your firms are headed.
Yeah, Tyler, I agree. These are the big chunky things. And a couple of things you brought up at the start of this call are key to understand how the tentacles of flow and expenses fit in. You had mentioned some of the costs are variable, but many of the costs are fixed. And when you start talking about what is your cash flow and what is your cash flow in an extended negative environment or positive environment, if you have bid off some of these larger technology projects, they have to be funded. And if your forecasting engine, whether it's a manual engine or a technical engine, is able to take into account some of these large known blocks of commitment, it helps you understand what your free cash flow really is. Because unless you model all of the big components in, again, you don't get the full picture. And eventually the spreadsheet just can't contain all the components. The other thing I wanted to point out was M&A. When we, Delta Data, look at M&A, nimble comes to mind. Frenetic pace comes to mind. Usually when the right opportunity comes along for us to go buy somebody, we have about 2 weeks to figure out what's the number we'll pay and what are the likely synergies, if you will, that come out of the deal. Having a tool that can evaluate the top 10 agreements of a target acquirer and see if there's material improvement in the distribution expense and project the combined book of business across an optimized set of fees is absolutely critical to get M&A right. Winning in M&A is all about finding the answers that allow you to pay what you're comfortable with, but that is a bigger number than your competitor. If you have more intel about where you're actually going to find real synergies than your competitor, you will likely win more M&A events. So with distribution expense being the second largest expense in an asset manager, it is critical that in an M&A session, you've got an idea of whether they're sitting on key relationships that have older, perhaps, or more advantageous agreements on selling. Just paying 5 to 10 bips difference in one of the big broker-dealer channels could be millions of dollars of EBITDA go forward. So having a tool that can take those inputs, combine the two books of business, and output the likely savings, if you will, on an optimized set of agreements is a core capability that these firms should have so that they win by putting a larger number that has real synergies backing that larger number.
Hey, that also brings in another good point. As we talk about different groups, technology, sales, distribution, operations, there's a lot of different, cost centers involved in actually producing a forecast. How have we seen groups manage that as far as, especially in a working from home environment? How are people giving their input to these forecasting tools? And does that actually increase the need for a pushed industry solution for a better forecasting engine?
Hey, Tyler, why don't you comment on, Casey Quirk's view of which processes have been fine transitioning into the dislocated environment and which have run into stumbling blocks? I think laying that baseline is probably the best way to tackle that question.
Yeah, absolutely. Look, so I think if you ask about the feedback from many firms, people were shockingly positive about their shift into remote working environments. I think there was some kind of upgrading and collaboration in technology systems that was required, but it was kind of worked better than many expected. I think the largest concerns that have been voiced by many firms are, one, around the how do you sell to new clients, right? So maintaining existing client relationships has been, in some senses, even deepened, and as people have been able to kind of help and navigate people through this challenging environment. But I think identifying and selling to new clients has been a pain point, and also thinking about how do you onboard new talent and train them, and especially younger talent, is definitely been a pain point. As it relates to data moving around the organization, this has been a pain point before the COVID crisis, and I don't see that working remotely really helped it, but I didn't see that it would necessarily really create a huge impediment either. It's just kind of, in many situations, was somewhat of a broken process to begin with. We've seen a stark increase in firms hiring chief data officers to try to get data governance and data quality improved, and data sharing around the firm more of a systematized process. And you've also seen big investments, right? One of the biggest investments on the tech side is moving towards a cloud environment to start to move some of that data into a more broadly accessible environment. So I think there's definitely action on the data front, but as it relates to working from home and shifting into the COVID environment, the data wasn't necessarily the largest pain point brought up.
So interestingly, we just moved last year our head of product to head of data, and promoted somebody to head of product. So I think a lot of firms are moving toward a keen focus on data, and I would agree. This was a manual process, was not a good thing within the four walls of the firm, and it has continued to be less than optimal. But I would say, to be fair, it hasn't really degraded. But I would add that what we've seen is a lot of training of additional personnel. I feel that people are wearing a few more hats, and that folks who are touching our systems are a little more broad. We have more people backing each other up, and we're doing more training. The point being is the business processes supported by technology, whether we're talking about forecasting or trade execution, the ones that are supported by technology, whereby a lot of the knowledge and the workflow of what's next is built into the platform, allows for a bit of scalability with the existing workforce by allowing more folks to support multiple hats, and allows for a little more flexibility of personnel. So as we talk about, what are back to your first observation, margins were down last year. They're going to be down again this year. Even though we seem to have been, as a industry, talking about our companies, somewhat resilient to coming back from this COVID issue, not talking about the health side, just talking about the bottom line of the business, that unfortunately did not affect fee compression, and it didn't affect outflows from active, which I'm sure many of the listeners on this webinar today are feeling the effects of those. So as we still get to not take a break from those pressures, we start thinking about how do we better leverage our workforce we have, and how do we distribute the work to be done across a smaller group of people. That gives us more flexibility in headcount. And I think also it allows us to be slightly more resilient, but I would agree with you. I don't think that the manual processes have absolutely blown up in a dislocated environment. They just haven't improved.
Great, thanks for that. We do have one question out here. Can you further outline the core capabilities needed for a successful M&A activity? Tyler, I don't know if you want to take a stab at that one first.
Yeah, so I think it's pretty wide-ranging. I'd say at least where our group has been involved is primarily the diligence of the investment engine, the forward flows, right? I think what often happens is you get a banker who will come in and pitch the idea, and the projections are quite rosy. So conducting the diligence both on the efficacy of those flow projections to see how much growth, how much revenue is actually kind of stable and can be validated versus how much is aspirational in some of those initial projections. Kicking the tires there is important. Clearly, this is a talent business, right? So when you buy something, you don't buy much aside from the people. So understanding those individuals, taking the opportunity to have discovery, understanding the retention type of program that might be put in place in order to retain those people, and how that's going to be integrated into your broader organization is definitely critically important as well. On the operational side, right, there's a number of factors as you look through just the systems, the tax records. I think that's where typically I've had less experience, but obviously all of those elements are quite critical when you think about dotting all the I's and crossing the T's before making an effective bid. But at least as it relates to some of the valuation elements, I think, and especially as it overlaps with the forecasting, I think being able to have a good sense of, how much and how reasonably and in what degree of confidence you can forecast the future asset revenue flows and that type of picture into the future, in addition to the existing cost structure and some of those cost synergies, is where you can tighten up that potential bid price that you can put together.
I'm completely shocked to hear that there's rosy projections and pitch decks in the asset management world. I thought that was just technical.
You'd never believe it.
Yeah. So I would agree with all those that she said, and just from my personal experience, I was on the team that worked to integrate Neuberger into Lehman, and clearly at that age, I mean, if y'all kind of date me in your mind, you're like, all right, you weren't a decision maker there, and I'm not at all claiming to be, but I was along for the ride in some very small meetings where some really interesting values, whether they were realized values or realized that there weren't a value there, kind of were resolved. And it is a people acquisition, period. You're buying a bunch of asset managers and their client base that's tied to their ability to make money in the market. So first and foremost, as a technologist, I don't want to say, forecasting flows and understanding your dealer agreements is the most important thing to try and sell software. It's a people thing. It's a people acquisition. And having those people committed to the go-forward company is probably the single most important thing based on my own experience working with Neuberger and Lehman. But behind that, where you leave the qualitative zone and you get into the quantitative zone of M&A, in my opinion, the most important thing, and by the way, my opinion is coming from trying to do M&A successfully from my own executive team is understanding how that business is structured from a flow and an expense perspective, and then modeling that into your world and trying to forecast correctly to go forward pro forma business. And the reality is how fast you can do that and how accurately you can do that will drive conviction of the person or persons who are putting a number bid out there to try and win. If you are good, you are fast and accurate, you will consistently put larger numbers on the table, frankly, that you can stand behind and won't get you fired 3 years from now when people realize you're just not good at it and you overpaid for something. But back to that timeline, even big companies that have billions of dollars of revenue, the M&A cycle is a hyper fast, frenetic pace animal. And having a forecasting process that anticipates what influencing variables it's going to be given, has a good UI to receive them, and can then apply those to data that's already in the system and ready to be modeled, that's super important. And that's where it gets into the technical details of, are you buying a DST-based fund? If so, get TA information and model it in at a high level. They're going to tell you what the flows are by quarter. Model it into the UI. But in your due diligence, you should be using real TA data in due diligence. And you should be tying it back to the assumptions that they gave you in the deck. That's another key thing about not screwing up M&A. If they tell you something, write it down. Put it in a system. They said they're going to do X in growth. They're going to do Y in expense cutting. Write it. All you guys do that. All you girls and guys do that. But have a system where you're recording it. And then when you're in due diligence, get the TA data and say, wait, this doesn't time out. I'm not saying, hey, go try and find a reason to retrade them. But having a system, not a spreadsheet, is very important to being able to consistently and repeat in a repeatable fashion, take input that are already known what you're going to receive, or the vast majority of what you're going to receive, model them against good data that's already available so that the projections can come out in a readily available fashion, in a timely fashion, and then spend all your time on the output, not spend all your time on the data collection and coordination of the process and maintenance of what's essentially a massive software program in macros and a spreadsheet.
Yeah. One other thing I'd add, right, as a strategy consultant, I've spent, the majority of my due diligences on, transactions that never ultimately went through, right? If you think about heads of corporate development, they're screening hundreds of potential transactions a year. So one other successful element of a due diligence is just understand what you really want to DD and understand what is just a screen and how do you move quickly through it. Because there's many, many, many firms that are out there on the market and shopping themselves. And trying to get a quick understanding of, how do these firms fit into our plan and, do these numbers actually add value, and being able to quickly pass on those that, clearly aren't accretive. It is helpful because there's plenty of firms that kind of get shiny object syndrome and do a ton of due diligence and work and digging heavily, and then realize maybe it's not the right fit, and they spent a lot of kind of human capital time and expense on doing that diligence. So being able to have even good screening processes up front also help determine where you really want to dig in and add value and go through the full diligence process and where it might not make as much sense.
Great point. 100% agree with all of that you said. And one thing that, just like you get rosy projections in a pitch deck, I've heard twice this said in the last 4 weeks: everything is for sale right now. Everything. So, just because somebody sends you a pitch deck, don't think they're the only people for sale. Basically, every large institution is in some way for sale to a larger one or one of similar size. And what that translates to is exactly what you said, Tyler. Whereby 5 years ago, we may have looked at 2 or 3 companies a year at Delta Data. We're looking at 20. we're getting pitch decks every week. And it's not a flood of worthless information, but you have to be able to quickly bring to the surface what's really intriguing and can add value, and quickly screen out, as you pointed out, what is likely not as interesting, and not miss the acquisition you really should have done. Out of that 20, you can't let accidentally slip by because you weren't paying attention, the one that could transform your business. So you have to look at all 20 and finding that repeatable process that's mainly based on quantitatively based facts to screen them in and do more due diligence, or screen them out and move on, is a key capability you got to have.
We do have one other question, and I think this kind of summarizes and maybe a good kind of way to roll this up at the end. We talked through workforce changes, upgrades in technology, M&A activity. What are the biggest strategic decisions that you see firms are going to have to make in the next 5 years based on where we are today in the market?
Tyler, I'll let you take that first.
Yeah. I mean, a lot of them overlap with some of the ones that I was laying out earlier. I think the big strategic decisions are, right, ultimately, do you want to be a fully at scale global manager, right? So there's a lot of firms that are rushing into the trillion club, and do you want to use M&A to consolidate? Because a lot of these big investments that firms are going to need to make in order to remain competitive are fixed dollar investments, and there's benefits to scale there. So that's one big question. I do think what the future of the working model is going to be kind of creeping up on people's lists as the longer we stay in this type of environment. So, thinking about that real estate footprint, thinking about how do you kind of manage your human capital is going to be a big one. I think the global piece is kind of increasingly becoming bigger as we move into more of a regionalized world, right? I think moving from 1990 to maybe 2010, there was kind of an ongoing push towards globalization, and I think we've pivoted and started to head in a different direction at this point. So thinking about how firms can truly be global, and if firms really want to do that, is going to be a big question that's going to be a substantive decision as well.
So I don't think anybody asked me my thoughts on globalization, so I'll leave that out, even though I have worked in 3 other countries. I will say, from a technical point of view, and from somebody making decisions in this drastically changing environment, change is here. Change is happening right now, and it's big change. It's not minor change. So my expectation as somebody trying to make decisions in this changing environment is a group of business processes, data, and people who can rapidly provide what alternatives we have, what the implications of the decision path we take will be, and what is likely the best outcome if we choose a path, or what is likely the outcome if we choose one path over another. So when I look at a counterparty to me in the asset management industry, I think they're asking the question right now: if we cut our global real estate footprint by 12% in year 1, 8% in year 2, 5% in year 3, and 5% in year 4, and we invest in technology at a rate 7% higher over those 3 or 4 years, what is the impact to our EBITDA? And then secondly, if we do this acquisition to try and get to that $1 trillion club, and these are the 3 firms we're going to go after, based on what we know, what does the flow look like? I'm expecting that in the next week or 2. This is where manual processes, ultra complex spreadsheets that essentially need handlers to even open them up on a computer start to really show their age from a capability perspective. And I'm not in any way inferring our software can do all that, but I am inferring that the core modeling, the core forecasting is something you need software to hold those forecasts. So the next time, which may be next week, you're asked to reforecast, you're not starting from square one. You're asking, well, what input is changing that you want to reforecast? okay, we think sales are going to be flat after November. All right. That's a single input along with 23 others that are going to stay stable into a forecast that here's the new one based on that. And here's what its name is, and here's its ID. And if you want to use that, now we can push that downstream to SAP or push that up to the M&A team. But that core thing, where are the models stored? What is the workflow system whereby people can log in and add the influences of sales, the influences of macroeconomic activity if they're an economist, and the influence of expenses if they're in distribution? Those assumptions need to be captured somewhere. That cannot be a full cost every single time you pick it up from soup to nuts. Your expense should be a fraction of the first time you do it. To do it the second time, you should be just modifying a variable, not starting over. So what I would say is, in this volatile market, expect more questions. Expect more questions that require serious work to answer. And the last thing you want to do is, every time you pick up your forecast, it takes specialized people, specialized data collection, and a bit of quality assurance just to make sure that hand-stitched together process didn't hit a bump in the road.
You've been listening to Nicsa Talk. Nicsa is a trade association supporting all types of professionals within the asset management community. For information on how your firm can become a member, visit nicsa.org/membership. Subscribe to Nicsa Talk on iTunes, Stitcher, or your favorite podcast app. And let us know your thoughts by reviewing our podcast on iTunes and connecting with us on Twitter at Nicsa News. For over 50 years, Nicsa has been connecting the people of the asset management industry to share best practices. Join the conversation today at nicsa.org.